Good evening everyone and welcome to this study circle meeting on tax audit, a quick referencer. Of course, this is the time when all of us are busy with tax audit, which has to be completed before 30th of this month, and an essential activity and an essential session too. So we have CA Krishna Upadhya with us for addressing us on this matter. I request him to come up to the dais. A quick introduction of Krishna Upadhya. He is a commerce graduate and a fellow member of the Institute of Chartered Accountants who has achieved 27th rank in CA final in 2011. With over 11 years of experience, he has been involved in helping clients with direct tax litigation, Indian entry strategy, cross-border mergers, structuring, corporate and taxation and transfer pricing. He is currently a partner with Upadhya and Associates, and earlier he began his career with EY. He is currently a member of Direct Tax Committee at Bombay Chartered Accountants Society and also a charter member of TAI Mangaluru. He has delivered multiple lectures at ICAI and other places. He has been on various panels to discuss matters ranging from income tax, international taxation, valuation, FEMA and so on. Apart from this, he is also keenly interested in tech enabling various finance practices and is a co-founder of a company named Audit ITEC, which is enabling this finance practices, technology enabled finance practices. So it's a pleasure and privilege to have Krishna Upadhya and introduce him to all of you. It's a pleasure to have you. Welcome to you for this session, and over to you for your session.
Me to address all of you on tax audit. It's one of those things in a year which is almost customary now. Tax audit was introduced in the law books long ago. Since then, tax audit has been a very key part of tax compliances in India for corporates, as well as a very key activity for chartered accountants in general who are in practice. It has, over the course of years, acquired various significance because of various things that happened. To begin with, it took significance as an audit because it was introduced because the finance ministry at that time felt that assessing officer needs support of some professional to actually help them right assess the taxes. Subsequently, what happened is more and more compliances became part of the income tax law, and somebody was required to sort of have a checkpoint where all those compliances are checked. Subsequently, tax evasion increased, so tax audit became a tool of avoiding or rather detecting such tax avoidance, tax evasion rather. Subsequently came demonetization, where provisions were introduced around that, and tax audit became a tool for the government to really understand whether demonetization and the impact around it can be captured. Likewise, tax audit has been evolving over the years. Though the method that we are adopting or the form per se might not have undergone substantial change, but the focus itself is changing indirectly because the law itself has been evolving in that direction. Today what I will try to do is that, like the title says, it's a quick referencer. I will try to give a quick overview of various things in tax audit. I'll also try and keep it as interactive as possible. It's a small group so that I could answer if there are any specific questions. I don't claim to know everything about it. It's been over 13 years since I've been doing this, but I certainly can't say that I can answer everything, but I'll try and see what all I can talk. If time permits, what I'll also try to do is that there is a tax audit quality review board report which came out a couple of years ago, which sort of has given out what are all the common errors that auditors do while reporting in PCD. I have a few things captured out of that. If time permits, I will also try and talk about them. Some basics. Applicability itself comes from section 44AB. It is in the following situations where it is applicable. One, sales turnover exceeds a certain limit. I think these are all pretty basic stuff, so I don't want to dwell too much into it, but I've captured some practical scenarios to explain all this in detail. So these things are pretty easy for you all to understand. 1 crore and above, if there is a turnover from sales, turnover or gross receipt, that is when it becomes applicable. Profession, it is 50 lakh and more. If the value of gross receipts of an SSC carrying on profession in excess of 50 lakh, tax audit becomes applicable. Person carrying on business taxable under the presumptive taxation 44 AE, BB and triple B. In those situations, if they want to claim their profits to be less than the presumptive limits that are prescribed there, you need to get a tax audit done. Profession, those professionals carrying on specified professionals, if the limits are or rather the profits that they want to declare is less than the presumptive limit which is there in 44 ADA, they'll have to get it audited. In situations where 44 AD4 is applicable, this is a slightly peculiar thing. I have again tried to capture this by way of a practical example. I'll detail it out over there. There is an interplay slide that I have done. New proviso has been inserted which is applicable for the current assessment year 24-25, which says that 44 AD be not applicable where a person declares profit under 44 AD1 or 44 ADA1. This was not there earlier. This has been inserted by way of a proviso. Not that it makes a considerable difference, but then there were some loose ends in the way it could be interpreted. To plug that loose end, this proviso was brought in. One important thing which is also being highlighted in the TAQRB report, that is the Tax Audit Quality Review Board report, is to say that the clause under which the tax audit is applicable, there are mistakes that the chartered accountants are doing in choosing the clause. Especially in cases of companies and LLPs who are audited under the respective law, under the company law if they are audited, or under the LLP Act if they are subject to audit. Depending on the threshold which is there under the LLP law, we may tend to choose clause A of 44 AD, which is talking about the gross receipts and turnover exceeding 1 crore. Actually, that is incorrect. What you have to choose is the third proviso to section 44 AB has to be chosen. TAQRB has also pointed out this is an error that a lot of auditors have been doing. So that is one point which becomes relevant. So choose the clause carefully. Choose the clause under which the audit is applicable. Basis that you can proceed doing it. What is business? Definition is there in the law as well. It includes trade, commerce and manufacture, or adventure or concern in the nature of trade, commerce and manufacture. It does not necessarily have to be all of them. It can be any one of them. It can be once in a while done also, it can be an adventure done also, but what becomes important is that, is there an intent to do business? If that is the case, then it falls under the category of business and therefore the tax audit will become applicable. Again, the definition of the word profession. Profession includes vocation. I think again basics. I just wanted to keep this comprehensive for everyone to understand. Therefore, I have captured all these basics as well. List of professions is given in section 44 AA. You will have to read it with 6F. Here is a list of all the professionals which get covered under 44 AA, read with rule 6F. Legal, medical, engineering, architectural, profession of accountancy, technical consultancy, etc. given under the law itself. Company secretary is coming out from a circular which is given out by the board. Film artist, cameraman and every other professional in that category are given by way of another circular under rule 6F, which gives you those professionals. Then editor, lyricist, pretty much everyone under the film and related category are covered. So these are the people for whom section 44 AA applies. Therefore, they are professionals for whom the threshold of professionals have to be applied. So that is an important part. When you are carrying out an audit of any of these professionals, make sure you choose the relevant clauses rightly in Form 3CD. Now, some peculiarities, whether nursing home is business or profession, has been a matter of some amount of debate. There are a few judgments which have said that nursing home per se is not profession, but it is business. Why the judgment has been delivered in that way, which is also what is the view that is taken in the guidance note issued by ICAI, is that it presumes that for a profession to be there has to be a specialized knowledge applied by a person. There's a concentration on a particular individual. A nursing home is probably a congregation of various such individuals, a certain procedure in which certain activities are conducted, there is a code of conduct in which that nursing home works. Therefore, the tribunal in a lot of cases have also opined that nursing home is not a professional, is a business entity, and therefore the thresholds applicable for business has to apply. This is what the guidance note also says. One important thing about the guidance note itself that I want to tell you. Now, the council of our institute comes out with a guidance note. In 2021, if I recollect correctly, there is a document, there is a release that has been done as to what is the strength of the guidance note or what is the validity of the guidance note itself. Institute gives guidance note a very supreme value, because as professionals we are supposed to conduct ourselves in a certain category, in certain manner. Now, there are differences of opinion amongst all of us itself on how to apply certain things. Institute says whatever may be the differences of opinion that you have, we are here to give you a broader guidance under which you can operate. Therefore, as members of the institute, for us guidance note has a very significant value, and following that is a very important aspect of our profession. Now, there could be another question comes, okay, as professionals we may follow the guidance note. Why should an SSE follow what is there in a guidance note? A taxpayer can take a different position, a tax officer can take a different position. To this, the defense also is that if you look at a lot of matters of professional interest, of matters which are interpretative in nature, which does not have a very clear mandate coming out from the law itself, it has been accepted by courts, including high courts, where they have given a very significant persuasive value to what is written in a guidance note. Therefore, it has a very significant value. Whatever is there in the guidance note, if at all it is applicable to your situation, kindly follow it. The third important part of guidance note is also, let's assume there is an allegation made against a member about certain potential misconduct. If you have been within the realms of the guidance note, if you have followed what the guidance note has said, you get a substantial protection from any misadventures that the authorities or the regulators might want to do on you. Therefore, you could have a egotist victory later on to say, no, I took a position which is not same as guidance note, but Supreme Court ultimately upheld it. Great, wonderful, you are a great interpreter of law. But if that doesn't happen, and if a misconduct is alleged against you, guidance note will come to your rescue. Therefore, whatever the guidance note has given, if it is applicable in your situation, kindly follow that when there is difference of opinion. When an opinion is clear, you have a very clear professional judgment made on it, maybe you can go against the guidance note also. Again, the word sales, turnover, gross receipts are not defined under the law. Our guidance note says that it should be given a commercial terminology. In each business, this term can have a specific meaning. The guidance note also says that you use the meaning that is there according to that. Sale proceeds of fixed assets are not to be considered as a part of turnover for counting it, even if there is a substantial sale of fixed asset. While counting for the purpose of turnover, this need not be included. In case of SSEs having exempt incomes, let's take the situation of a cooperative society whose income could be exempt or could be subject matter of section 80P. In such situations also tax audit is applicable because it is applicable on the gross value. Where it can be different is in case of agriculturists who have only agricultural income. Despite the value of the agricultural income or the volume of the agricultural income, for them, because their incomes are not covered under business or profession, you don't have to count that for the purpose of counting the threshold for applicability of tax audit. In a commission agent scenario, sometimes there could be difficulty in determining whether tax audit is applicable or not. In that situation, what is the nature of conduct of that commission agent becomes critical. If that commission agent is a buy-sell agent, he is taking delivery of the goods, there is a risk and reward that is getting transferred in the commission agent's favor, and subsequently he is transferring further to somebody. In such situations, the entire value of the goods are to be counted for the purpose of determining whether tax audit is applicable or not. In situations where he is just acting as a mediator or an intermediary to connect the buyer and seller, all he earns is a commission for doing that activity. Only the value of the commission is to be determined. Therefore, you have to be very careful in determining what is turnover in the case of commission agent. There could be different contracts that he undertakes in the same year. Somewhere he takes delivery of the goods, this is transferred. Somewhere he only acts as an intermediary. There could be a possibility that an SSE would have credited everything to the trading account or profit and loss account, or they might not have treated it as a part of trading account at all. So you will have to be very careful in identifying such things, identify the nature of contract that he has undertaken, and accordingly tax audit applicability has to be determined. Creditable indirect taxes, input tax credits of GST, etc. Should you make it as a part of turnover gross receipts? Whatever is the method of accounting you are following, inclusive method, exclusive method, which is there in the guidance note, basis that you can decide. If as an ordinary practice, if you are taking that also, the output taxes rather, I said input tax, I was wrong. So output taxes, if you are crediting to the trading account, in such situation, make that as a part of counting whether the threshold is reached or not. If ordinarily you are routing it through balance sheet, you are treating the output taxes as a current liability, then you don't have to include it while computing the threshold for the purpose of tax audit. One thing you have to be cautious is that don't change this position based on your need year on year. There has to be some sort of consistency you maintain. You will have to determine consistency. And you have to make sure that the SSE is maintaining consistency. I have seen in certain situations, contractors tend to, in some years they are in the borderline, they say that, no, I don't want indirect taxes to be part of my turnover. Sometimes because they want to apply for some bank loan, they want to show a higher turnover, they would want to make it a part of the turnover and show higher turnover limits. So such things, as auditors, please don't allow that, because that determines inconsistency and that will be incorrect. And not getting tax audit done will attract penalties, therefore you need to be careful about it. Sale of scrap have to be included as a part of turnover, provided that scrap is a very important part of that business. There is a byproduct of a scrap that comes out from, let's say, a manufacturing. In such situations, the guidance note of the institute says that scrap value has to be included as a part of the turnover. These are now getting very popular, especially in the post-COVID era, where a lot of people are carrying out speculative transaction of shares, where people are engaging themselves in carrying on futures and options trade, etc. So how to determine the value of turnover for the applicability? Guidance note says that you take all the values together, remove the negative, that is the minus sign, add up everything, cumulate it. If that value exceeds the limits as applicable, you will have to do the tax audit for it. I know practically there could be some challenges. There is a salaried individual, did a huge amount of speculative transactions during the year, or did a huge amount of transactions in the form of future trading and option trading. It could get difficult, but unfortunately that is how the law is. That is how the guidance is available to us. You will have to treat that as business income. You will have to consider it for the purpose of tax audit. If after accumulating everything, by removing the pluses and minuses, if that exceeds the limit, you will have to make sure that the tax audit is made applicable for that. Share of profit from a firm. Let's say I am an individual, I am a practicing professional, I am an individual practitioner, I have my gross receipts, I am also a partner in a certain firm, I get a share of profit. whether now share of profit also has to be included into the value of the limit, value of the receipts to count it for the limit. The answer is no, you don't have to do it. One interesting thing is on interest and remuneration. There were contrary judgments. There was a Chennai tribunal which had said you have to include it. There was a Kolkata tribunal which had said you don't have to include it. Matter is pretty much settled now by way of a High Court judgment, the judgment that I have quoted, which is there on the screen. Perizan Zorabian is a film actress. She was a partner in a partnership firm and she used to get remuneration from that. The question was whether her gross receipt should include that remuneration from that firm also. Bombay High Court said that it is not required, though it is an income from business or profession. To count the limit for tax audit, that is not required, is what the Bombay High Court has said in this judgment. Now the next question is, if there are more than one business by an SSE, what do you have to do? Guidance note says that you will have to aggregate all of those turnovers to determine whether the tax audit is applicable or not. However, if there are business activities for which that respective SSE wants to avail the presumptive taxation, that you can separate it out. You don't have to count it as a part of the turnover for counting whether the tax audit is applicable or not. This is what the guidance note says. If there is no such intent by the SSE to go under a presumptive income, all businesses put together, whatever is the gross receipts, has to be taken for counting the threshold for tax audit applicability. I have also given a para referencing where that is covered. Some interplay I have captured here, slightly controversial sometimes. I have spoken, I have delivered the tax audit lectures at multiple places. Everywhere a few things become controversial. I will still maintain my position. My position is what is captured in this slide. What have I done here? Let's assume there is a SSE who is eligible, that is other than companies and LLPs, which is individual and HUF, who are an eligible business. Let's assume the turnover is less than 1 crore. Their declared profits is less than, let's say, 8% or 6%, as the case may be. I'm sure you're all aware 8% is when and 6% is when. Let's assume it is less than that. Now the question is whether you will have to do tax audit or not. In my view, tax audit is not applicable. Whatever may be the cash component in their turnover, in their expenditures, etc., you don't have to do tax audit. If you want, you can go under 44AD. That's a choice that you have. If you want to go, you can go. It's again not a mandate. But you can file your tax return without both of these also. You don't have to get yourself audited, nor you will have to go under presumptive basis. You can mention your turnover, expenditures in the columns that are there in the return and file your tax return when it is less than 1 crore. Now, if it is between 1 and 3 crore, why have I taken 3 crore? The limit of the presumptive taxation is 3 crore for the current assessment year. Therefore, I have taken that as a second threshold to count. And let's assume somebody's turnover is in excess of 1 crore. 44AB kicks in. That is because the limit under 44AD is 1 crore. 44AD, the limit is 3 crore. Now, if somebody is in between this, let's take a couple of scenarios which are here on the screen and see how does that apply. Let's say somebody wants to declare less than 8 or 6% and their cash component in total receipts and payments are also less than 5%. Is 44AD mandatory? Again, it's an option. 44AD is not a mandate. It's a presumptive income. You can choose to go in. You need not go in as well. If you choose, again here audit is not mandatory. You can again file your tax returns without carrying on audit, even in this situation, which is very critical. However, let's look at the next scenario. That is, your cash component is in excess of 5%. Then you want to offer profits less than 8 or 6% as the case may be, then audit becomes mandatory. This is the critical part. If it is cash component is less than the threshold available 5%, you need not again get yourself audited. You can go ahead and file your tax return without the audit. This is my view. I am happy to listen to a contrary view to this. Now let's look at the next threshold, 3 crore to 10 crore. Why again 10 crore? If the cash component is not there, the limit of the tax audit goes up from 1 crore to 10 crores. So because of that, now I have taken that threshold also. Here the declared profit.
This third option,
Yeah,
more than
yes, sir.
8%, best to choose 4480.
Best to choose 4480, absolutely. You don't have to explain anything to anyone.
No, why to choose 4480?
No, you can choose 8% or 6% as a presumptive rate.
For example, my business profits are 90%.
Okay.
Still I can choose 8%.
No, you can't. No, I did not say choose. Okay, so let me clarify that position also. Both under 4480 and 4480, this is applicable.
Yeah.
If let's assume my gross receipts are 100, out of that 100, 90 rupees is lying in my bank account, or is invested in mutual funds, is invested in shares, etc. Can I declare my profit to be 8%? In my view, answer is no. It has to be 90% because your 90% is sitting there itself. Otherwise, all your investments will become undeclared. Is coming from sources which are not declared. The presumptive taxation, if you go back in time and read when the presumptive taxation provisions were brought in into the law, it said that we want to give an option for small SSEs to reduce their burden, who cannot produce all the documents for expenditures and proof for all of that. We want to allow a presumptive taxation. That nowhere means that you will be protected from all kinds of things under the law, even when your profits visibly are much more higher, but you are declaring the lower profits. This is a constant position that we have been adopting consistently. There are many professionals who don't agree with this, but we still believe that that is what it is. Am I with you on this, sir? So that is what it is. I strongly believe that is how it is supposed to be treated. Now, with a lot of professionals, let's say tech professionals, working from home, sitting out of India, servicing a international client, lot of situations, they don't even have costs. Their gross receipts could be substantially higher. Most of the money that they have earned will be sitting as fixed deposits, investment in mutual funds, and etc. Now, can you declare straight away 50% as their profit under 4480? My answer is no, you can't do that.
But there are judgments which say that the assessing officer cannot look into.
So those are all tribunal judgments as of now.
Yeah.
Now, you know tribunal judgments how it is. It keeps going from one end of the argument to the other end of the argument. Now, if somebody has already done it, you can use it as a defense. But when you are advising somebody, my request is don't advise it that way, because if it goes to the other end of the spectrum, unnecessarily you will have to take the blame. That's right. If of course visibly the turnovers are around that 8 and 6% or whatever the presumptive rate, it could be 10%, it could be 12%. I said going for 4480 or presumptive taxation is better. It's not that I am recommending that even when the profits are higher. Now, going to the 3 to 10.
Section specifically says whichever is higher.
Whichever is higher, absolutely.
The section says whichever is higher.
Completely with you. It's not that it is mandating you to go to it, and it doesn't give you a protection if you go to it, but if you have investments which are not supported out of your incomes, which are offered to tax, that doesn't give you a protection. Those tribunal judgments, sir, has not tested the position of whether that investment gets covered under 69 that is now tested.
That is why, as far as profession and business concerned, people can declare 8%, their profession and business is
Protected. Is covered.
That is a section of, out of the business of profession, 69, that is whatever there.
But comprehensively looking at it.
Comprehensive correct. But as far as somebody is declared, but he has to fight with this work. That's all.
So that's why if somebody has declared it and
now they are reducing the. It's not. I am suggesting or not. Reducing the time period, all those things. For them, themselves, they have made that.
Yeah, reopening is becoming difficult for department now. The time period has reduced. There is checks and balances. There is 148 now.
SSC is insisting that can do. As per a chartered accountant, we should not recommended.
recommend. That is what. I completely agree with you. If SSC is hell bent on doing it and want to test his luck, he might as well do it.
So the best thing is give him a snapshot of the section and ask the assessee to take the call.
I don't know how many of them are capable of doing that.
No, because the section itself says whichever is higher. So he will.
So, but unfortunately, the point is, if you just Google on this,
All the websites say it is ad hoc selection.
yeah, ad hoc, that is what your assessees will come to you with. Their clients will say, Sunday is saying this.
Sir, the assessor is not yet what is profit. We don't know anything. He said that I am not having any books of account, nothing. How can you say that his profit is that, that? He said nothing is I maintained.
Because there are judgments to say bank account is not books of accounts.
No, there are
That's
judgments
why
say banks are there, books of account also.
that is why he says that business and
There are
profession is
judgments which
protected.
says bank
You have to
account
pay
is
the
not
event
book of
collector and other sections.
So, in the 68A situation, there are judgments to say bank account is not books of accounts.
68 section only, there are judgments which say bank of account is a books of account. They are also there.
Yeah, so it gets murkier and murkier if we try to dig deep into it. So I think overall one consensus can be arrived at is if somebody wants to really do that and test their luck, allow them to do it after knowing all the consequences.
Sir, my doubt is how officer will derive. Say for example, out of 100 rupees, 90 rupees is the profit. I showed 8 rupees. He is telling it is 90 rupees. How officer will get to it?
Yes.
Because books of accounts,
Books of accounts is not
Yes, information and other things are with them only.
with them. So the information is available.
no, purchase, sales, so okay, sir.
It's not determining it from a P&L
That's
standpoint.
why the professor is not asked. He goes to section 16 and 68, 16 and all those.
Yeah, he'll go to that because the investment that he has made has to be explained. There is a source for that investment. That source has to be the money on which the taxes are offered. Now, if you are saying my profit itself is 8 out of 100, but my investment is 25, how do you justify it?
If you are able to
Under 69, you cannot do it.
They will ask.
Why can't we do it? If we have the document, we can do it.
Yeah, of course, if you have the document, you can do it. If you cumulatively over the years, if you can show. Those are, of course, your professional intelligence that you can do. Ordinarily looking at it, it is not possible. 69A does not permit if you declare a lower profit. So that is what it is. If by way of your professional might, if you can do it, you are helping your client, please do it. Now moving further, when it is more than 10 crore, the option is not there. Tax audit is mandatory. Same way, professionals, this is pretty simple. There is not much complication. Just for the sake of completeness, I have put that here. This is very easy to understand. Some other audit basics. Tax audit is to be conducted by chartered accountant. 288 defines who is an accountant. There is a relative definition in that which excludes that you cannot carry out audit for your relatives. That relative definition is different from the definition which is there under section 56. So please be a little careful in choosing. If at all you are doing audit of your own family or all of that, be careful about going through that definition. Seek an NOC. Please don't do even a tax audit without seeking NOC. Even in this year, we had a situation where there was a disgruntled previous auditor. The client kept saying, no, he'll give you an NOC whenever you want. But then as professionals, when we spoke to him, that CA had a lot of things to say, we finally did not accept that tax audit. Therefore, kindly make it a practice to seek NOC. If NOC comes straight away, good. If it is not coming by, we are all, here as professionals, we have a fiduciary responsibility towards each other. So, please make sure that you talk to that other auditor before accepting a tax audit engagement. Get a letter of appointment. 210, SA 210 gives you a broad format. Shripriya ma'am has done a fantastic job. She's given a lot of formats of letters of engagement, representation letters and all of them. It's there in our website. She keeps posting that on her LinkedIn handle as well. Please make use of that if you don't already have one. Tax auditor is also required to, of course, I made one mistake. This code of conduct which is in place because the elections are ongoing. I am not recommending anybody's name. I used Shripriya ma'am's name only to recommend the document that she has put out. Let me be conscious about that. Tax auditor is also required to express an opinion on the financial statements when the audit is being done for a non-corporate assessee. So you have to exercise all your judgments as an auditor in expressing an opinion whether the financials are true and fair. Is also required to give Form 3CD. This is the table which captures it. If there is any other audit that is applicable, Form 3CA becomes applicable. If no other audit is applicable, 3CB becomes applicable. Interestingly, TAQRB says that there is errors that are made by professionals in choosing 3CA and 3CB also. I don't know how can that happen, but yeah, please be careful about that and make sure that you choose the right form of audit report. All the other standards on auditing also is applicable: sampling, materiality, relying on the work of an expert, etc. So please make sure that you're covered yourself from a standards on auditing standpoint. There is a responsibility paragraph which is recommended, the client's responsibility as well as auditor's responsibility paragraph recommended in SA 700. TAQRB specifically points out that there are innumerable tax audit reports where that is not put. Again, my humble request, even in the department utility where you upload the tax audit reports, you have option to place these paragraphs. Please make sure that you place these paragraphs. Yes, sir.
It has a limit of 2000 characters.
Yeah, you'll have to trim that paragraph down and you'll have to put it there. I know it doesn't cover everything which is there in SA 700. So what we do, I'll tell you, what we do is that we do the entire tax audit report, 3CD, everything separately. We write there that this electronic form has to be read along with the manually signed, scanned, attached 3CD form along with this. Because all the caveats that we want to write, all the limitation in scope that we want to write, everything we write in that 3CD and we attach it there. So that question of limitation of characters is taken care of that way. That is what we do. The guidance note also says that preparing 3CD is the responsibility of the SSE, and you are certifying that, you are auditing and certifying that wherever possible. If on the client side there is ability to prepare 3CD, at least get the first draft of the 3CD done by them, and then after that whatever recommendations, changes you want to do it, you could get that done. There is that entire thing on examination of books. So I've covered this subsequently, probably I'll talk about it later. Yeah, so observation columns are available wherever you want to make some observation. The best method is, like I said, prepare everything separately and give it. It makes it that much more comprehensive for you to do. If for time constraint or any other constraints you can't do, any important observations that you want to write, things like, let's say, inventory records are not maintained correctly, or whether for the, let's assume, whether account pay checks are issued or not, nobody maintains that data. Such kind of at least minimum disclaimers, I would recommend that you put it as a part of your observations in the report itself, so that you are covered if tomorrow a question is raised on you. Due dates as applicable for this assessment year. As of now, whatever is the due date, in case there is any change in future, can't say. I have given that out here. Filing has to be done under the CA login. I think everybody is pretty much aware of it. SSE has to add you as a chartered accountant. The chartered accountant has to accept and then file it. After it is filed and SSE accept, only then the process is deemed to be completed. There is a circular on this which states that if that is not done, even filing by the CA, the date is not relevant. Only once it is accepted, it is relevant. So make sure that wherever there is a gap on that, that gap is within the time limit which is available. UDIN is to be mentioned. You can either do it at the time of filing itself, or you can obtain it later and update it. As a good practice, what you can do is that make sure that you tabulate all the reports that you have done, because I do understand that we have very limited time to carry out, records might not be correct, we'll be racing against time. You can generate UDINs probably in the first week of October or so on, and then go back and update all of them, and you don't miss them. What happens if you have not given a UDIN? I'm not too sure what will happen. It's a professional incorrect activity, because as professionals we are supposed to do. Income tax, does it say that UDIN is mandatory anywhere? There is one DIT circular, that is the Department of Information Technology Income Tax Department circular talks about that there has to be a field for UDIN and all of that. What is the legal validity of that? I am not too sure. Because that's not coming from the law itself where it is mandated, nor it comes from the rules where Form 3CD is given or 3CB, 3CA is given. Nevertheless, I don't think so there is any debate on that. All of you will be doing UDIN. Signed financials, what we again do is that we make sure that signed financials are uploaded wherever it is to be uploaded. SD, blank, without signatures, etc. as a practice. I would recommend
using DSC, then
I think it's a good practice. You can fix your digital signature also.
then that's also
That should be sufficient. That should
you
be
can write SD and then attach DSC.
attach DSC where?
While uploading the form, we are attaching DSC.
On the form is the financial certified by the SSE. SSE has to sign the financials and we have to certify it.
No, when we are uploading the form, we are using DSC.
Sir, we had a situation where one professional came to us, said that they had filed off a tax audit report to help the SSE within the due date, etc. Later on, the SSE came and said, "Who asked you to conclude this balance sheet?"
That's the exception, we can document everything.
So instead of documenting it separately, get the balance sheet and P&L itself signed off. Whether it is a digitally signed off on the PDF itself or the physical sign off and scan it. Always better. In your good interest, these are done. If you want,
Suppose they had taken prior email from that.
yeah, I think that should be okay. Prior email should be okay, but then avoiding such practices are better because you
But
never.
that is everything, but
Sir, my duty here is to tell what is the best practice that is applicable. Now, you want to water it down and apply it for yourself? It's your professional.
is there any mandate that it has?
There is no mandate. There is absolutely no mandate.
You can upload.
Guidance note says that get it signed. Guidance note also talks about it.
But not physically signed. No?
Not physically signed. Digitally signed is okay. But he's getting an email confirmation sign off is something that you will have to think about it.
No, not email. In the email, we agree that DSC is valid.
That should be okay. That should definitely
We
be.
are not physically signing, we will use it.
That should be absolutely fine. That should be fine. That there is no problem.
So uploading the financials without a signature, it can become professional misconduct
Yeah, it can be. That's what.
because there is nothing to be validated.
Absolutely. That's why getting it signed off is the best. I have seen people write ST and upload it.
Original copy get it signed. Copy if it is STFT, it will be audited as copy of that.
Sir.
In the earlier that company balance everything is.
Sir, that was earlier days, sir. So now it is mandated that you have to attach the signed
Signed
financials.
financials means I have got the signed financials. We have the signed financials. You have everything with me and copy is with the client. Original is with the client and copy is with me. And
Sir, when everything is hunky-dory-
get a easy purpose. If there somebody is put sign. If there nothing is changed in that, what happens?
No, if everything is hunky-dory, there is nothing wrong because this is not.
I have to sign the copy, nothing is single paisa, nothing is difference in that. Financial
Correct.
statement, what is the sign?
Fair enough.
Because converting PDF and other things are very easy and you have to upload it.
No, I am talking of a scenario where somebody disputes it with you. Then what is the defense that you
I
have?
have copy of that, the same is paisa, sign.
Correct. You could have uploaded that itself. Now that defense you don't have. That is why I am saying it is
Who will
recommended that you
dispute?
do.
Client will dispute, no?
Yeah, client has to dispute. Sir, clients do dispute. Clients do dispute. That is why I am being. That is why I am.
They don't pay on time, they'll expect them.
Yeah, when they want the things differently, they'll dispute everything. So that's
They'll
why.
provide only on 30th evening.
No, it's not
Okay.
about whether the client disputes or not. The moot point is whenever you get a financials, it should be signed by the person so that it is authenticated. Because when we go for a bank audit also, we ask the manager to sign the balance sheet and then give it to us.
Correct.
Though it is printed from his own system.
Correct. The right practice is that it has to be signed by them. You audit it and countersign. That is the requirement.
As soon as we see sign, then it is very
No,
clear that it
signature.
is authenticated.
Yeah, absolutely.
DSA or signed.
Yeah, it is physically signed, digitally signed.
Signature brings in the responsibility of the management for that reason.
Correct. So now what you're doing, all the other practices that you said, it may protect the client. How does it protect you? Because at the end of the day, as professionals, you also need to be fairly protected with the kind of regulations and the NAFRA orders that are coming out, etc., you better be protected. That is the whole intent of me bringing that up. Yeah, and the format of financials, if any law prescribes a format, kindly follow that. For a non-corporate assessee, the technical guidance on financial statements of non-corporate assessee is applicable up to 31st March 2024, where vertical format of the financials have been prescribed by the institute. From 1st April 24 onwards, that financial statements for year starting 1st April 24 onwards, that is for the year ending 31st March 25 onwards, the technical guide is taking the characteristics of a guidance note. A guidance note has been brought out. Therefore, I strongly recommend follow that format, because that will give, again, like I said, I already told about why guidance note has its own importance. So for that reason, I would think that you should follow that. There is, if you have missed looking at it, there is a guidance note on financial statements for LLPs. There is a guidance note on financial statements for non-corporate assessees also. Both of them were technical guides before. From 1st April 24, they are becoming guidance notes. So kindly make sure that you refer to them and follow the format that is given out over there. Consider issuing hard copies of the report. Like I said, as a best practice, we follow this. We have been following it. We give out the hard copies, deliver it to them, and that itself is also submitted along with the e-form. Now I have taken a few clauses here, some things you will already know. I am just mentioning a few important things. These are all gathered from guidance note, my practical experience, and TAQRB. Looking at all of this, I have given a few things. Name as per PAN is to be mentioned here. In case there is a different trade name, guidance note says mention the trade name also. If there is a trade name and an SSC name, mention both of them is what it says. Now in the form, how do you do it? In the online form, you can't do it. You can only put one name. So mention the name as per the PAN. Mention all indirect tax registration numbers. On this also, TAQRB has brought out instances where there are mismatch in the indirect tax registration number. GST numbers which are quoted over there are incorrect. What could be the reasons of it? Is it a quality control issue, copy paste errors? I don't know, but those are errors that have happened. And if a particular SSC has multiple GSTINs across the country, write down all the GSTIN also, make an annexure out of it. I think even the online utility allows you to list down as many rows as required, so make sure that you mention all of them. Guidance note also says that under the customs law there is no other number, IEC number. Now IEC is also replaced with PAN itself can act as IEC. However, if somebody has an IEC number, mention them as well, is what the guidance note says. Yeah, so last one, whether the SSC has opted for those new regimes of taxation, 115 BA, BAA, BAC, BAB, etc. How do you certify as a tax auditor is one question that becomes very relevant. Because after you issue the tax audit report, the SSC decides which is the regime of taxation that they want to go under. And there are forms to be filed before that, for opting for it, for withdrawing, going into it, etc. All this may happen after you have issued the tax audit report. How do you do? For this, what the guidance note says is, go based on two things. One, or rather three things it says. One, if something has been done in the last year. If the SSC gives a representation to you that they wish to go under the same thing this year also, go based on that, mention that here. Second, if the SSC has already filed the form indicating that they want to go under the new regime of taxation, whether it is an individual or a new manufacturing company or a startup, etc., basis that form, you can make a disclosure here. If none of the two are there, take a representation from them as to what is the manner in which they want to compute their taxes and make a mention here, is what the guidance note says. What is books of accounts? Again, the law defines what is books of accounts, ledgers, daybook, etc. Some peculiar things. I am again going back to TAQRB's references because that becomes important for you. Otherwise, these are all pretty simple. You would have been doing over the years, you all know it. What is books of accounts? There have been instances where whether maintaining books of accounts is mandatory. There's a question, right? So TAQRB says even for companies, some auditors have said no. But that is not the case, right? Because the Companies Act makes it mandatory to maintain books of accounts. So that has to be yes. Things like this have been given by TAQRB. Make sure that is there. Rule 6F prescribes for certain professionals, particularly the medical professionals. There is a list of things, daily case register, etc. that is to be maintained. There are a couple of judgments also on this to say, if it's a nursing home, it is not applicable for them. If it is a hospital formed in a corporate setup, 6F, whatever is prescribed is not applicable for them. It is for an individual doctor, is what it says. So when you are auditing a hospital or a nursing home, please be careful to mention whether it's a yes there or not. Because the guidance note is saying so and there are judgments on it, you can probably make a no for it. If there are more than one activity that somebody is carrying out, there can be multiple scenarios. I think I've captured that somewhere. Yeah, so maybe I'll come to it later. In case books are kept in more than one location, please make sure this is written down. One peculiar challenge that may come is, let's assume there is a company who is required to maintain their books of accounts in the registered office. If they don't want to do it, they need to communicate it to the register of companies by filing a certain form. Let's assume they have not done it. But their books of accounts, as tax auditor, you determine that are maintained somewhere else. Now what do you do? Guidance note says here that whatever they have declared to ROC, they have or have not done is a call that they have taken. But you audited a books of accounts kept in a certain place, make sure you mention that as the address where the books of accounts are being maintained, is what the guidance note on tax audit says. In case of maintaining records in a digital form, guidance note also recommends that the IP address of the server where these records are maintained have to be mentioned, which is a very critical requirement as days goes by in cloud computing days. Now, especially with cloud-based software tools, there are certain tools which don't have their database and data centers in India. That makes a significant difficulty. You please advise your clients to make sure that, and more often than not, all these software providers will have an option to choose between an India data center and a data center outside India. Make them conscious about the fact that they need to test that and see whether the data centers are within India. This is from a different perspective, from the data secrecy perspective, etc. Even from a audit trail and Companies Act perspective, you need to have that. But for limited purpose of tax audit, guidance note says that mention the IP address where those data, books of accounts are maintained. Digital form or not is also to be given. If a digital form of some of the records are maintained in a certain place, it is also to be mentioned. If there are certain documents you could not verify because they were not made available to you, what are the books of accounts maintained? You list them down as per the representation by the SSC. What you audited could be a yes or no. You can say something was not given for your verification and therefore you could not audit it. That also you have an option to write it that way. Now, this is another thing. So this clause, if you see in 3CD, it asks whether profit and loss account includes any profit and gain accessible on presumptive basis. If yes, indicate the amount and relevant section is what it says. What does this indicate is that, let's say there are more than one activity that a particular SSC is carrying out. For some activity, they want to go under presumptive basis and that turnover of that is routed through the P&L that you are auditing. Then you will have to mention it here. In case that turnover is not getting routed through the P&L that you are auditing, let's take the example of, let's say there is an individual SSC who has a restaurant business, who has a petrol pump. He is running both of them. On petrol pump, he wants to maintain books of accounts, get it audited, etc. Restaurant, he wants to offer it on presumptive basis. Is he allowed to do that? 100% yes, he is allowed to do that. Now, as auditor, what do you have to do? Let's assume in the P&L balance sheet that you are auditing, there is no reference to this hotel business whatsoever. Then you don't have to report anything over here because that's not a subject matter of your audit. However, if it's the same books of accounts in which all that have been routed, but for hotel business he wants to offer it at a presumptive basis, you will have to make a mention over here. So those are the scenarios that are covered here. More than one business, books not maintained, what will happen, etc. You can go through this, not too much difficult to understand. Method of accounting and ICDS reporting, which is there in clause 13. Hybrid system not allowed. For something cash, for something accrual, not allowed. One can completely follow cash basis itself, unless they are a company or an LLP. Because Companies Act doesn't allow. LLP Act read with the LLP accounts rules does not allow maintaining cash basis. But for an individual HUF, they are allowed to maintain cash basis. Hybrid does not allow. That is what it says. Effective 1/4/2015, ICDS was made mandatory. Change in accounting policy is not change in method of accounting. Let's say there is SLM to WDV change, etc. It's not change in accounting method of accounting. It's just change in accounting policy. That disclosure in clause 13 is not required. Now, impact of ICDS. On this, the TAQRB has written a very huge commentary as to where the assessees are going wrong. One particular thing I will point out in this, I don't have too much time to talk about all of them. Let's say there is valuation of inventory. 145A says that all the credits of input tax also, rather whatever indirect taxes are paid on procuring a particular inventory item has to form part of the value of stock, is what section 145A as well as ICDS 2 talks about. However, accounting standard 2 and Ind AS doesn't allow you to make creditable indirect tax inputs as a part of valuation. Naturally, there will be a difference in valuation as per 145A and books of accounts. But in effect, it makes it zero, because if you add it to the value of purchases as well as to the value of stock, when you take COGS, it will be netted off. So you add to both the places or you eliminate from both the places. But 145A makes it mandatory to add. So TAQRB also says that give a proper disclosure to state that if I add the indirect tax impact on purchases and on stock, this is how my P&L will look. If I don't and I treat it, this is how it will look. Ultimately, it is neutralizing the impact. Is what has to be shown, is what the guidance note as well as TAQRB gives out. My recommendation, if you have entities where there is substantial amount of manufacturing stock and indirect taxes impact on that, please go through that part of the tax audit guidance note where the table of how to display that also has been given by the institute. So this is what I covered over there. Pretty much. So this is that increase and decrease, how it has to be given. That is the 3CD table also, which I have given it out over there. Amount not credited to P&L account. This is one other slightly peculiar thing, especially in the cases of individual assessees. Let's assume there is an individual balance sheet and profit and loss account that you are auditing of an individual or an HUF. They have a business income as well as they have, let's say, an income from letting out of house property. The income from house property are not routed through P&L account, but they are credited to the capital account of that respective individual. Now the question is, do you report that here or not? Because what it says is amount not credited to P&L, being 1, 2, 3, 4, 5. It talks about various things falling within the scope of section 28. Pro forma credits, drawback, escalation claims, any other items of income, capital receipts if any. If that part of the income is not even forming or coming within the portions of your subject matter of audit, the balance sheet P&L, you don't have to report anything here. Let's say there is a separate balance sheet of individual that they maintain, or they don't maintain anything, but rent is not routed through these books, then it's okay. But it is routed here, but not credited to P&L. In my view, as well as what the guidance note says, is that you report. One challenge which is there is when you report it. In 143.1, when it is coming, CPC is adding that additionally, saying that this income is not offered to tax. There is this difference in 3CD and it is raising the demand. This has happened over the last 2-3 years continuously. N number of 154s you file also, CPC is not acting on it. One relief we got is we went to the AO, gave 154 applications and got it rectified. In order to avoid that, if you don't report, then you are doing an incorrect reporting. That is where it's a little difficult situation that you have. Yes, sir.
This rent is taken through withdrawal account,
Yeah.
and it is never shown in the capital account as rent at all.
Yeah.
Whatever are the income or expenses, personal thing, is routing it to withdrawal account.
Yeah.
So there is no explanation.
Then
for
it's
that.
okay. Then it's okay. So let's assume there are let's say 2 bank accounts that particular SSE maintains. One bank account is exclusively used for business. One bank account is used for all other personal affairs, to get the rent, to get interest, dividends, etc. All these are part of a single balance sheet and single P&L account that is given to you. This rent, dividend, interest, etc. are not routed through P&L account. You have to credit it to the capital account while accounting for it. Now the question is, should you report it or not in this clause?
No, if it is shown separately, you have to report. But he is taking all his personal entries to withdrawal account.
Ah.
To drawings he is taking it. For example, he is
So debits and credits are all netted off in one single withdrawal
For
account.
example, he has sold a property, it is also routed to withdrawal account.
Yeah.
So the capital receipt should be reported here.
Yeah, that is what. See, in my view, all of them have to be reported here. Let's say there is a capital gains, has to be reported. There
He
is
is reporting it in his personal balance sheet.
Yeah.
Here he is
in personal balance sheet. If he is maintaining separately, it's not a subject matter of your audit. You don't have to report it because it's not within your purview at all, right?
My question is, all these incomes is being credited to his business balance sheet, business bank account.
Okay.
And he is taking those entries in his personal balance sheet to a withdrawal account in the business balance sheet.
Right.
Now, whether those things, whether you need to bifurcate everything and put it here.
I think yes, because it is within the purview of the financials that you are auditing, and you need to report it here. If let's say it is not at all routed through this financials, it's not coming to this bank account, then it's okay. You don't have to report it. So then you don't access to all of those records which you are not auditing. But if it is routing through your balance sheet, whether as a separate called out line item or through withdrawal account, you will have to report it here.
Because he is offering those things to taxes.
Tax, absolutely. There is no infirmity as far as not offering it to tax is concerned. It's a matter of reporting. But unfortunately, when you do that,
If you do that, then defective notice is coming up.
exactly, that's the trouble.
And it is adding twice.
Yeah, it is adding twice. And it's a loop. How many other times you try to tell file 154s, there is no use of any of that. Yeah, I know that's a practical challenge. Some of the things I have captured here. Clause 18, which talks about depreciation, one thing that you'll all have to make sure is, it doesn't talk about, so what it talks about is depreciation allowable under section 32 is what it says. That means you have to sit on the judgment to decide whether that depreciation is allowable or not allowable. Let's say somebody has made payment in excess of 10,000 rupees in cash to acquire a capital asset. Now in the actual cost definition, it is not covered. Therefore, section 32 doesn't give you depreciation for it. You will have to make that judgment. It's not merely report what is given, you have to make the judgment whether it is allowable or not. That becomes very critical, so that I thought I will highlight. 3615A, contribution to provident fund and all of those. Employee contributions not paid within due date, multiple judgments, etc. We were checkmated by the checkmate decision of Supreme Court. Ultimately saying that the due date has to be due date as per the respective acts. Now that is prospectively applicable. There is another judgment for that also which I have quoted. Now it need not be retrospectively applied. Now there is a very interesting argument that Guraj Acharya sir made in one of the conversations was that under the PF law, the deduction to, let's say, deduction from employee is happening when the disbursement of salary happens. There is a change in the wording or the language of the Provident Fund law and ESI law. Provident Fund law says this. Let's assume you have accrued that salary at the end of the month You might have shown PF deduction at the end of the month. Let's assume you did not pay it within 15th of the subsequent month. You paid it on 20th. One defense that you can take is that under the Provident Fund law, it says that the deduction happens when the salary is disbursed. Let's say on 1st of the next month you disburse the salary. One small window of opportunity is available for small mistakes that might have happened or delays that might have happened. But if it is substantially beyond that, of course there is no cure now, because law is also amended. There is an explanation brought in under 3615A, Supreme Court judgment is there and all of that. But this is one thing that I thought I will highlight to all of you. Yeah, 21A talks about details of expenditure in the nature of capital, personal, prohibited, etc. 3 new additions have happened in the 3CD which is applicable for this year, which were also changes in section 37. One, any penalties levied outside India is also now not admissible. That disclosure as separate column has been brought out. If there is any compounding of offence that you did for a law within India or outside India, they have also now been brought under section 37 explicitly. There is a disclosure for that also, which is there in 3CD in clause 21 that is there. So you will have to be very careful about that. Few things like whether late filing fee of GST is penalty, etc. I think in my view it is not. Late filing fee is just a compensation for late filing. Interest is very clear, it is just compensation for the time lapse. Even GST late filing fee is not, but there is penalties under GST law which is levied for incorrect claiming of input tax credit, etc. Those are penalties which are covered under section 37. Remuneration, this is I think pretty well known to all of you, is allowable only if it is there in the deed. And how it should be, there is that circular, 1996 circular, which says that it has to be very explicitly written down, otherwise it is not allowable. Department takes this stand consistently, so I think wherever in your LLP cases or partnership cases where remuneration clauses are not defined well, kindly make sure that it is defined well, otherwise the allowability of the remuneration itself may be questioned. Filing utility gives a format of how that has to be done, how book profit is computed and all of that. So I just thought I'll tell you on that. 40A3 cash disallowances, some challenges could be like I said in the beginning, which is reporting on account payee check. Nobody would have maintained that information clearly. That could be one challenge. Make sure that you write suitable disclaimers. Disclaimer is also given in the tax audit guidance note itself. You can adopt that for your safety. Then agricultural produce, one important thing, Rule 6DD gives you exception that whenever there is a purchase from an agriculturist, in such situation, first purchase from the agriculturist to the trader, Rule 6DD gives an exception that cash payments can be made. Trader to subsequent trader or to a ultimate consumer, can you pay for agricultural produce in cash? The answer is no. That is not covered. There was a notification that was given. There is a press release made by the department on this, so that you need to be very clear. 2017 there is a press release. I have quoted that over here. 40A7 gratuity, superannuation fund, etc. Little small overlap between 40A7 43B. If it is funded, there is a fund, etc. It goes under 43B. If it is unfunded, you are making a accrual based on an actual valuation. Consider reporting it under 40A7. 40A2B, you don't have to, this is payments to related parties, you don't have to sit on the judgment chair of a assessing officer to say whether it is excessive or unreasonable. You only have to state whatever payments have been made. There is no judgment that you are required to do. Clause 22, two things here. One is MSME, which was already there, interest which is there under the MSMED Act. New addition is 43BH. Be careful, under the regular 43B disclosure clause, 43BH is not covered, it is covered in clause 22. All you have to do is, if there is any disallowance under 43BH, only that has to be reported. In the other clause, you have to report both brought forward, paid during the year, current year, how much is incurred, paid within the due date under 139(1), not paid, etc. That detailed disclosure is not required in 43BH case. For an MSME case, that is not required. Only what is required to be disclosed is if you determine there is a disallowance to be made under 43BH, which is it is not paid within the time limit of the credit period agreed or time limit as prescribed under the MSME law 45 days, then you will have to disclose it here. One other thing is 43 say somebody might have got a MSME certificate or a registration for them for any purpose. Let's take a situation of a trader for the purpose of obtaining certain loans of the government guaranteed schemes, etc. They might have taken, but strictly MSME Act is not applicable for them. They can get themselves registered. The protection which is available under the MSME Act is not applicable for traders. It is applicable for manufacturers and service providers only. For you and me, it is applicable. We are covered if at all we are registered as a MSME unit, it is applicable for us. But for traders, it is not applicable even if they have an MSME certificate. How do you determine whether somebody is a trader or manufacturer is the next question that comes up. That is a challenge. There is no single database through which you can get all of this. If there are n number of creditors, can you sit and determine everything as tax auditor, etc.? Humanly impossible to do all of that. What you can rely on, guidance note says that there should be an internal control practice by the SSE to identify who are all MSME. Take a representation by them. Do a test check to determine whether it is right or wrong. Report it based on your test check and write a disclaimer. This is the 4-step process that the guidance note gives. I would think you all should be following that.
What will be the quantum of the test check?
Sorry, sir.
What will be the quantum?
Standards give you how to do sampling. Standards on auditing gives you how to do sampling. Sampling can be either a test check based on statistical method, or you will have to do substantive testing if there is no controls, etc. You will have to go by that. So this is just detailing. I was told there was a detailed session on 43BH that has happened, so I am not going into it. Of course, this slide will be circulated, I guess, so you can get access to it. Okay, reporting 43B, no reporting related to DA and H, I told you. Here it is not. So clause DA is about the demurrage charges which are to be paid to railway. So that reporting is not there in that. Maybe it's just a error of not including that in the clause. 43BH is covered elsewhere. SENVAT reporting whether GST to be reported, guidance note says not required. Says that GST credits are not part of SENVAT law, so therefore, and this clause has not been amended at all, despite the fact that it is now 5 years since, 2017, it is 7 years since when the GST came in, but they still have not amended this, so guidance note says that only if there is SENVAT credit, that needs to be reported over here. Prior period item, every earlier year expenditure is not a prior period item. If something got crystallized only during this year, though it pertains to a past year, is not prior period item. You make your judgments whether something is a prior period item or not. If there is one, 27B reporting is going to come. 269 SS and T, no, not that. So this is 29A.
Class 27, there is no need to report ITC.
It is not required. That is what guidance note says.
But in the table it says SENVAT or ITC.
No, input tax. So SENVAT.
In utility,
Uh-huh.
when you fill up the form, in the table it says SENVAT or ITC.
Is it? I'm not too sure on that because at least the guidance note says you don't have to report it.
Guidance note says it is not required to report. But the utility.
But the form 3CD itself, I think, is not amended.
Yeah, it's not amended. Even class 26 mein that H is not included.
Yeah, I know. So in clause 26, H is not included because 22 includes it. That is why you don't have it in clause 26. You don't report 43B H under 43B clause. In the MSME clause in clause 22, it is already there. That is why it is not required.
They ensure that the form is updated. Whether to file the current form or wait for.
No, now the There is one backdoor entry that always department has been trying to do, right? They introduce certain things in the ITR utility, they introduce certain things in the 3CD utility, the way they want it. I don't know, some of them may not be legally permissible at all, because those are not there in the law. But that is how they have been doing it. You don't necessarily have to wait till everything is updated, and they may never update it also. So you keep filing based on the latest utility that is available in the department portal. And if something's missed out in that, if something's missed out, you have done your duty of filing it as on that day. It is their duty to make sure that the form is updated. As far as I know, Form 3CD for the SENVAT credit, there is no change. GST input credit is not covered under the Form 3CD, which is notified. But if it is there in the department utility, then I'm not sure. But I still feel you don't have to report because the notified form doesn't have it. 269, one thing is 29A, it's taxation of advances received on agreeing to sell an immovable property. For after that the advances are forfeited. If such situations are there in the balance sheet that you are auditing, again it goes back to the conversation that I was doing earlier. If it is a part of the balance sheet and P&L that you are auditing, you have the obligation to report. If it's a personal transaction that somebody has done outside of the balance sheet that you are auditing, you naturally can't report it, and you don't have to report as well. Clause 31, 269 SS, ST and T. Simple things first, 20,000 and above, whether cash or not, everything has to be tabulated there. And you have to determine whether it is a yes or no. If it is received in modes which are not prescribed, whether it is prescribed. That is what you have to do. It's not that you have to report only when there is a violation. You have to report every time. Every loan accepted, every loan repaid, every transaction covered under 269 ST has to be reported. Whether that entails a penalty to be levied, it's a violation of 269 ST, is for the assessing officer to determine and take a respective action later on. Number one. Number two, if you also look at this clause, 269 SS talks about acceptance of loan, repayment of loan. There are subclauses to say, if you have received a repayment of a loan that you have extended, which are barred by 269 SS, that also you have to report. This to me is backdoor entry. Because 269 SS or T doesn't talk about that from your perspective. From your perspective, if you have taken a loan, if you are repaying a loan, what is covered? You have given a loan, somebody repaid it in modes other than prescribed. That is not subject matter of 269 SS and T for you. It could be for them. But you are required to report as an SSC, and an auditor of this SSC has to certify that. That to me is very peculiar. It's been there in the form, and then unfortunately we have to report that. But if you have extended a loan, gotten it back, those also you have to report. Book entries are also to be reported. So this is another thing. Let's say there is a loan extended to, or rather loan taken from somebody, and then there is money is receivable on sale of goods against the same party. You knock the two off. That also you have to report it as received in modes otherwise than prescribed. Because what is prescribed is very clear. Account pay check, account pay bank draft, electronic credit, etc., etc. UPIs and all of those. Book entries are also to be reported. This is also very categorically covered in the guidance note. It says that please say that it is accepted or rather repaid in otherwise than the modes prescribed under 269 SS.
So this interest entry also has to be reported.
Sorry, sir?
Interest. That is also to be reported.
I don't think so. Interest need not be reported unless you are crediting the interest into the same account. You are adding the interest into the same account and repayments are happening, then you may have to report. If interest payable is routed through a different account, according to me, you don't have to report it. Brought forward loss reporting, how can you do it? Verify the previous year tax returns. In case there is a litigation going on, a particular brought forward loss has been adjusted by way of an order, 143.3 order, then make sure you make a mention of that in the remarks column which is available there to say that this was the loss which was reported by the SSC. However, there was an adjustment and an appeal is pending against it, if an appeal is pending. So make sure that you write that down clearly. Clause 33 talking about chapter 6A deductions. Again, I go back to what I said. If there are chapter 6A deductions which are identifiable from the balance sheet that you are auditing, then you report it, number one. Number two, to report things like 80JJAA claims, where there is a separate audit report of a chartered accountant is required. If you are doing that yourself, fine, you can report it. If it is being done by someone else, make sure that you get that certificates before you sign off for 3CD, or you get a representation from the SSC that this is how the computation is made and I am eligible to claim this deduction. After that, report it here and make a suitable mention in your notes that this is based on representation or this is based on work of another auditor that you have relied upon. Chapter 17B, clause 34 reporting, capital expenditures also will come. What are these? If TDS is not deducted or deducted not paid, deducted paid late, deducted paid inadequately, all of that. It's not necessary that only P&L items have to be reported. Chapter 17B covers everything. Section 40A talks about expenditure debited to the profit and loss account. That is not the wording that is used here. Every chapter 17B violation has to be reported over here. Again here, is it the violation only to be reported or everything to be reported? The table that you see over there says that if there is a, let's take 194C, contractor payment, it says what are all the payments which are covered under this. Out of that, on how much TDS is applicable. Out of that, on how much TDS has been done is what it asks. So it is asking you to report the entire thing first, carve out each of those and report it separately. Will you be in a very large SSC, especially let's say builders, will you be able to verify everything? Again, test check is the only way to do. Make sure that you gather as much as data as possible, take the ETDS returns, take ledger extracts, do computations that are possible and report it, and write the limitation in your scope in reporting to say you did a test check, you relied on these many things and this is all you could report. If you try to do everything, in a smaller SSC may be possible, in a large SSC it becomes difficult. Clause 35, details of stock. Again, this has to be prepared by the SSC and given to you, the movement of stock. Trading concerns and manufacturing concerns are for whom this is to be there. If they don't maintain it in that way, especially in manufacturing concerns where conversion records are not maintained correctly. There is a raw material that is going out and a finished goods that comes out. The conversions are not maintained correctly. The form requires you to mention that conversions also. If you can't do it, put a disclaimer stating that those records are not maintained and therefore you are not able to audit them and report it here. Any amount received deemed to be dividend under 222E, deemed dividend, to the extent possible you can identify them, do it. Is it really possible to audit a deemed dividend from a receiver's angle? I don't really know. It could be very challenging to determine that itself and report it. In case there is, for instance, let's say there is a SSC who has taken a loan from a certain company. Now, how do you know whether that calls for reporting under 222E? It's very difficult unless you have access to the company's financials also. So in such situation, it becomes difficult. Ratios, these are to be done only for SSCs engaged in manufacturing and trading. Service concerns, this is not required to be reported. That is very clearly given in the guidance note. And also the TAQRB also talks about, in case you can't report it for all the categories of items in a P&L, etc. For critical ratios, you will have to report it here. In case you can report it at a P&L level, please do it. If there are different forms of businesses, consolidate it into one P&L. Let's say an SSC has, like in my earlier example, a hotel business, let's assume it is under audit. There is a petrol pump business which is also under audit. And there is a third business, let's say some trading business which is also under audit. While you are filing your, when you are filling your, rather signing off your P&L account, you may consolidate everything and sign off. Then ratios, how do you determine? Because each of them will have different ratios. So what the guidance note says, or rather even the form says, is for principal activity report it. Whichever is the principal activity that you determine, you can report that. Net profit to be reported, net profit ratio that it calls for to report is profit before tax and not after tax. Stock in trade includes only finished goods, would not include raw material. Clause 44, which is the GST reporting, again a little peculiarity over here is, do you have to do a proper reconciliation with the P&L account? Report everything that is there in the P&L account, give a breakup of all of that. Guidance note says that it could be impossible to do. Because it is impossible to do, you do to the extent that is possible for you and the records are maintained for it. Tabulate to the extent that the data is available and report it. In case the data is not maintained at all in a manner in which it is possible to put it in this table, or the SSC is not able to give that, guidance note says that put a disclaimer that you did not get enough information to report it over here. Now, let's assume you got the information to report. It also says that transactions which are exempt from GST you have to report. As a receiver of a service or receiver of a goods, how can you sit on judgment whether something is exempt or not? The exemption is being determined by the seller, right? So the supplier who is supplying that goods or services is the one who is determining whether it is a exempt and things like that. How can you determine all of that? So that becomes very challenging. So that column typically is excessively difficult to report unless somebody has a system like this. Somebody's invoice says the goods supplied out of this are exempt from GST is given in their invoice, and your client also has a mechanism to capture that and have tabulated all of that and produces it for you, and you are able to validate it as auditor, then you can report it. And in real world this is impossible to do. Therefore you can consider to write suitable disclaimers on it. See, the whole point is, what is the department, income tax department, making use of this? Does anybody have answer to it? Have any of your clients got notices based on data which is reported here? Or in assessments, have they used this data to ask you some questions? At least I have not come across anything like that. So it's just burdening the SSC who is supposed to do, and more burdening on the auditor who will typically be collating all of this to report under this. Now even reverse charge. How do you report reverse charge under this clause? Unclear. Do you have to report it itself is unclear. So that is the difficulty of clause 44. Revenue and capital expenditure, should you report both or only one of them? Again, no clarity. In my view, it says expenditure, doesn't say expenditure debited to P&L account, so therefore capital expenditures will also have to be.
Guidance note says we need to report both.
Yeah, it says you need to report both. Yeah, you'll have to report. That's what I said.
Yeah, both capital and revenue both.
That's correct. You'll have to report both. Yeah, exempt supplies I already spoke about. Yeah, so this was the planned content that I had. So I have the next 25 minutes on. If there are any questions that are particularly there, I'll be happy to answer them.
In respect of reporting in clause 48(7), you had mentioned that if there is an actuarial valuation report, you just report it under 48(7), otherwise report it under 43.
No, I said in case there is a funded gratuity fund. Let's say somebody has taken a gratuity, created a gratuity trust, created a gratuity fund to which, or taken an LIC policy for gratuity, group gratuity. Such cases you report it under 43B. The ones which are done based on actuarial valuation, you are making provisions based on actuarial valuation, and you are following a pay-as-you-go approach. As in when somebody is eligible to get it and they are retiring or resigning, you are making a payment. Those reported under 40S.
Even though it is not actually funded, sometimes it so happens that there is an actuarial valuation report and contribution goes in accordance with that to the fund, so to say.
Then you report it under 43B. If there is a fund to which you are making contributions, report it under 43B.
Otherwise 40 years.
40S.
And in respect of reporting under clause 21, where we have to mention the opening balances of certain liabilities. So in those cases, there are in large companies and multinational companies, every month they actually create a provision.
Correct.
And they reverse the provision.
Correct.
So should we actually align the balances to the as per the ledger account, or is it sufficient we just actually mention what is the amount that is paid and what during the year and what is unpaid at the end of the year?
I think it is enough to make it based on what is not based on the provisioning, which is based on the actual. So typically I understand what you are saying. So the debit is given to the expenditure account and credit to a provision account. As in when bills come, they keep knocking it off into a creditor's account. That is how it keeps happening. So in such situation, in my view, you don't have to align it everything with the provisions made. You can just do it with the actuals which have been done. That way reporting is better.
Basically actuals. What
Actuals.
is paid during the year, what is remains unpaid, and what was utilized from the opening.
Absolutely.
Premium paid to the LIC that can be claimed as deduction.
Sorry?
Premium paid to LIC that can be claimed as deduction.
For gratuity. So in case there is a group gratuity scheme that a particular assessee has availed, and premium, what is a premium there? So how typically it happens from let's take from year 0. Year 0, when you take a group gratuity scheme of an LIC, they determine based on the number of people that are there, what is the total fund contribution that have to be done. You need to make that first fund contribution to LIC. After that, every year they ask you to do a true up, true down. Based on the people who are quitting, adding, based on the mortality rate, life expectancy rate, etc. They ask you to make a modification. That balance is actually premium. Therefore, it is like contributing into a fund. And you can claim a deduction for that on actual revenues. Huh? The difference amount you can claim it as allowed under 43B on payment. Connected question from my side to all of you to just learn. What is the position that a lot of people are taking on this group gratuity? Are people complying with that circular that came out? Is anybody going ahead voluntarily registering themselves, taking group gratuity schemes and all of that? Because that could be a substantial blow to cash flow for let's say a sizable organization. If let's say there are about 100 people working, that could be a sizable contribution that you have to make to that gratuity. At least all of our clients have taken a position not to contribute to it.
Did you say in the beginning review, tax audit review, or that you will be talking about?
I kept mentioning there are a few more. There are a few more on TAQRB. If you want me to put it up on the screen, I can do unless there are any other questions. Wherever I could recollect and mention, I did mention it there.
So checkmate services is prospective or retrospective?
Checkmate services per se doesn't talk about prospective or retrospective, it just lays down the law. The tribunal judgment which I have quoted here, including the Bangalore tribunal, says it is prospective. It is not retrospective.
From the wordings of checkmate, it seems that it's only clarification, but the law was already there.
But after the judgment, sir, the tribunal has ruled that it is
So
prospective.
it is contradicting the Supreme Court.
No, is it really contradicting? I don't know.
Because we,
Past cases, are you all contesting? Any of you
my
contesting?
colleague is contesting, there are lots of notices coming out now.
Okay,
On checkmate services, huge liabilities are being created.
created. Those, like I said, tribunal can go from point A to point B at any point Z to any point in time. So, if you think that there's a certain wording in checkmate which talks about it being just clarificatory, that means it is applicable from day zero.
Yeah.
It is retrospectively. I think you should take that position.
So partners, interest and
Remuneration.
remuneration, they are getting it per check. So the limit will be 10 crores.
No, for that tax audit, for counting the tax audit limit, that is not even applicable. Interest and remuneration need not be counted.
But it is taken as business from profit.
Income from business, it can be taken, but it need not be counted for the threshold of tax audit.
And the share of profit.
Not to be counted. Not to be counted. Share of profit, there was clarity even earlier. In interest and remuneration, there were contrary judgments of tribunal. Bombay High Court has now clarified that that also need not be counted.
If it is credited to the account.
Doesn't matter, sir. Doesn't matter.
If you have to get yourself peer review,
Yeah.
then it is only the statutory audit that comes into place, or even the tax audit part?
Tax audit also comes into
It
place.
is both of them.
All your test engagements are counted.
Does this income on section 44,
Yes, sir.
does it apply for agriculture income?
No, that doesn't have to be. I spoke about that in the beginning. Guidance note also talks about that. If there is agricultural income, it is not to be counted for the threshold, and naturally 44AB is not applicable.
So an F&O transaction, how do you draw profit and loss account?
If I want to learn from everybody. So there is a particular method we are doing. I also don't know whether that is right or wrong. Now what we are doing is that whatever the statement of that F&O gives you, both in terms of the favorable positions and unfavorable positions, we are crediting and debiting it, netting it off and taking it. Is that the right way to do P&L? I am not sure.
Because in also ITR, F&O, they are asking for the actual turnover.
Correct.
Not the premium or the favorable unfavorable.
Correct.
So if we are drawing only favorable unfavorable, we are leaving out the actual transaction. So that can be a problem.
I'm not sure. I'm not an expert on that. There are very few things that we do on that, and then that is like the method that I told you is how we are doing that.
We are also following the same. Because you only get those data.
Because that's the only data that is available, and
The
premiums are available.
premiums are available, transaction value is also available.
Correct.
But the moment we say our turnover is 100 crores, thus, I mean the
Perception about the necessities goes up.
yeah. If we say it is only 50 lakhs, the perception is something different.
Correct.
But we say that the associate has done a turnover 100 crores and he has made a loss of 5 lakhs. Next thing
Only
is to get a
5 lakhs.
scrutiny notice.
So I was asking only 5 lakhs.
I got clients who are more than 50 lakh on turnover of 1 crore. What to do?
Because one thing is, one argument is, since it is only favorable and unfavorable, take that as in your profit and loss account.
Okay.
One thought is, whatever is the transaction value, that you take it in your profit and loss account.
Okay, okay.
But it is the sale and purchase and sale that difference. Transaction A is favorable, transaction B in the similar way is unfavorable. Unfavorable and favorable you have to consider as a total.
That is for counting turnover for tax audit. So I was asking about how do you prepare P&L account?
So, from accounting perspective,
Yeah.
what
How do
is
you?
the actual way we need to do is turnover means the transaction value.
Correct.
So if the transaction value is 100 crore, we need to show 100 crores only. But what we are doing is we are only taking the premium
Difference of it.
profits we are taking.
Yeah, correct.
Since in that case we are not taking delivery,
No, this
as
is
a mentioned commission agent is
concern.
so don't consider that transaction turnover. In
Take only the difference.
difference like commission in this whatever that
No,
form.
no. The guidance note says for the purpose of calculating the limit under 44 AD,
Correct.
it is favorable plus unfavorable.
Correct.
It doesn't give a guidance how to prepare the profit and loss.
Profit and loss. I agree with you. I agree with you. But what I think he's trying to say is, because you're not taking delivery of that, it's just the difference that you're either enjoying or losing. Take only that. which is what we are all doing as well, right? So, therefore, the argument is that because we are not taking delivery, that's the right way to do P&L. But is that the right way? I'm not too sure. I'm not too sure.
How does it differentiate with the intraday, the derivative with the intraday?
I think it is the same even
Same
there.
thing.
It is even same even there.
No, but that will be considered as a cash transaction. No, it will not be considered as a derivative transaction. The intraday is a cash transaction.
Correct. Intraday, you funded it. It's not a
Yes.
derivative. Yeah.
Correct.
It's a cash transaction. So in either case, I think the base logic is the same. You don't take delivery of either the stock, and the difference alone you either enjoy or you suffer.
No, the difference here is when you do a cash transaction, you put a margin, upfront margin. Whenever you do a derivative, it is only the premium amount that is to.
So should that make a difference in the accounting? Because you are funding that margin, should that make a difference in the accounting?
That's what I'm asking. Should not be the total amount of cash transaction to be taken as cash sale and cash purchase. That's my question.
I'm not too sure, sir. I don't know that. Because there is no guidance on that very clearly anywhere.
But the intraday it becomes the speculation. F&O will become the regular.
Yeah, that's correct. From a taxation standpoint, F&O is regular. It's not considered a speculative transaction. Intraday is speculative. So this QR code takes you to my LinkedIn profile. If any of you wants to connect me and there is anything that we can discuss, I'll be happy to do that. Thank you so much for listening.
Thank you, Krishna, for your time and sharing your knowledge with all our members. On behalf of Bengaluru branch, we thank you wholeheartedly. Can I request our MC members, Chandra Prakash, to hand over a memento to Krishna Upadhya. With this, we come to the end of this session, and we'll meet you next with the next new subject next week sometime. Thank you all. Good night.